And I want to start because you were in Washington all last week for the International Monetary Fund and
Right.
World Bank meetings.
Right.
They did raise the Philippines GDP forecast for this year. It's not a lot, but still 6.5 from 6.3.
They downgraded the whole world and upgraded
and
the
you were
Philippines.
upgraded. I want to underscore that because it makes me wonder, you've mentioned recently that you have to see traction in the economy to support going ahead and starting the rate hike, starting the normalization. So are you seeing more of that kind of traction that will allow you to do that? You got a meeting in May, but maybe that's a little too early, or you think you could consider
economy
it?
bounced back by 5.7% last year from a recession in 2020. And then we expect the economy to grow at 7 to 9% this year. And then we'll go back to our normal 6 to 7% henceforth. Okay? So, we see the improvements. For example, manufacturing index is 52.4.
Yeah.
That's the highest in 3 years. So plus foreign direct investment last year grew by 52.4%. Globally, foreign direct investment went down, but foreign direct investment went up in the Philippines last year.
So I want to ask you about inflation in the context of a couple of things. Number one, the International Monetary Fund also boosted your inflation forecast for this year to, 4.3%? Only not too far above your target, 2 to 4%. At the same time, it seems to me a big question for central banks around the world is the Ukraine war has vastly, accelerated the food and energy price increases. So your headline inflation gets very high. At the same time, it really hits your consumers and businesses hard. How are you sorting that out? Is that going to be a force then that moves you faster toward the rate hikes or slows you down?
Yeah, the 4.3% adjustment in the inflation projection already incorporates the impact of higher oil prices and the possible other food commodities, world food commodities. But we also see that will go back to 3.6, and that's within our target range in 2023. So that's from 4.3 to 3.6. So it's still within our target range.
Does that reduction in inflation back down to what you say 3.6% next year? Does that incorporate then this expectation there's probably going to be at least 2 to 3 rate hikes to help bring it down?
Yes, plus the assumption that oil prices will normalize by next year.
Okay. Another thing I wanted to ask you about was the debt. And another thing that Secretary Dominguez mentioned was the idea that the economy is going to have to grow, I think he said at 5 or 6% for the next 5 years to help pare down the debt. I know your standing with the ratings agencies is quite good now. Do you agree you're going to need that kind of growth? And do you factor that into your policy decisions? Is it going to mean that you have to be a little more careful with the rate hikes? What does that mean? Yeah,
the situation is that before the pandemic, our debt to GDP ratio was around 39.6%. It went up to 60.5% as a result of the pandemic, but that's still manageable. I think globally, the debt to GDP ratio is 260+%. Okay, so to me, we can easily outgrow that debt, and that's consistent with Secretary Dominguez's view. As long as the economy grows at around 6 to 7%, we'll be okay, because that's the denominator. As long as the denominator is growing much faster than the numerator, that's fine.
Lowering the RRR rate, you say, is on the table this year?
Correct.
Under what conditions? Because that seems to a certain extent to go in the opposite direction of raising the key rate.
That is not related to the crisis at all. I made that promise when I assumed the governorship of the central bank. I said I plan to reduce the reserve requirement. At that time was 18% to single digit. And so that's still on the table. Okay. I think because by doing that, you are taking so much money from the banking sector. That's over-regulating the banking sector. So I will allow them to lend out the money rather than the central bank getting the money from them. Let them lend out to the public. Just
one more quick follow-on question, and that is in terms of capital flight, Fed raising rates aggressively, others raising rates. Do you have any concern that that's another reason why you might have to raise your rates as much as you said or even more aggressively?
Well, you know, in the past, and I've seen many crises in my lifetime, okay? Every time we have a crisis, we run out of dollars, okay, to pay our foreign exchange debt. That's no longer the case. As I said, we have a hefty gross international reserves, and our debt is very small. In fact, our foreign debt to GDP ratio is only 39.6%.
Pretty impressive.
So to me, that's not a scary concept. And I think that if I have money, and we have another fund, the FCD, Foreign Currency Deposit Unit, that's a backup, and that's significant also. If I have money, why should I bring it out of the country when the possibilities are very nice in the country?